Hey, thanks everybody for joining us again today at the Today's Market Explained podcast, a video and podcast series from 4-Star Wealth Advisors. Today, we're going to learn a little bit about venture capital and get an update in the venture capital market. We have Brian Smiga, and he's the co-founder of Alpha Partners. And welcome, Brian, to the Today's Market Explained.
Hey, Brian, great to be here. And you're in my second favorite city after New York, San Francisco.
Yes. And I'm doing this interview from the airport in San Francisco, out here on the due diligence meeting for some of the offerings that we have on our 4-Star platform, including venture offerings and a new diversified alts fund that we're doing that will have a bucket that you can invest in venture capital. So, Brian, you're a really very experienced professional entrepreneur in the venture capital space. And, now we're coming out of the pandemic. It seems like it's pretty much over and all the pandemic effects are out of the way. What is happening? If you could just tell us, Brian, what is happening in the venture capital world?
Yeah, I think what's really exciting about the venture capital world is that the flywheel of technology intersecting with every business, every industry that your listeners might be involved with hasn't stopped. But because of both the pandemic and then the rate increase, the entry prices to get into venture-backed companies has come back down to normal. So it's a reverse to the mean of entry prices, which means like if you're buying an enterprise SaaS company that has recurring revenue, you might be paying 6 to 10 times revenue for a great company. But 2 years ago, you might be paying 80 times revenue. So how do you make money pay that multiple? You don't. And you wait forever to get your returns, no matter how good the company is. So this is the most exciting thing for your listeners is that we were in a bubble in terms of private asset prices, and we're now back to normal. And I think it's going to stay normal for a while.
Okay. So why was it so distorted, Brian?
Well, venture and tech growth equity have outperformed in many ways over the last 20 years. I mean, let's just look at the S&P 500. 30% of it are tech companies in terms of market cap. Well, it was single digits 20 plus years ago. And think of how many brands we rely on today because of the internet and mobile and cloud. Apple and Facebook and now called Meta and et cetera, Google, et cetera. Look how many companies sort of reinvented themselves for the cloud in today's world, like Microsoft and Oracle. So tech has outperformed in creating value, in creating wealth, and capturing more and more of the economy. So as a result, all these dollars started chasing venture, right? And there was this big overhang of capital. And as funds got bigger and more eager to get into deals, they started raising their offer prices. And then that was combined with what we call the tourists in the industry. This would be the Tiger and the SoftBank of the world that raised, $100 billion funds and would make rapid fire decisions to get into anything. And you also have corporate venture. So all these corporations had excess capital they were investing into venture. So all this money chasing the deals is why the prices got too big. However, the original reason why all that money wanted to go into tech, that hasn't abated, right? Tech is still, we think, the place to get outperformance, whether you're investing in a 3 to 10 year horizon.
Interesting. Well, good. Well, it sounds like things are, as you say, normalizing. What kind of trends do you see? Obviously, technology is one of them, but where are the areas best for opportunity in the venture capital investing world?
Sure. So Alpha's really lucky in that we invest in mid-stage venture. Why is that a lucky place to invest? I'll tell you why.
Okay.
20 years ago, my partner and I started our careers. There weren't so many early stage venture capital firms. There weren't as many companies at the starting line. Think of it as a marathon, right? And a company like Amazon could come to market, be in the market for 4 years, and then go public and raise, let's call it 400 million in a public offering. Today, a company like the next Amazon is going to stay private for 10 years, and it's going to grow to be what's called a deca unicorn, meaning it's going to be worth tens of billions of dollars when it goes public. So this had a couple of effects. First of all, it's denied the retail everyday investor the ability to buy into tech names, because by the time they finally come public, they're overpriced and there's not as much upside. So when you invest in the mid stage, you're much closer to a predictable exit, maybe like 3 to 5 years.
Okay.
Whereas with early stage, you might be having your company locked up in the companies for 10 plus years. So we like mid-stage for the predictable duration. We like mid-stage for the predictable risk. If you were to just shoot darts at Series C rounds, so, venture rounds go C, A, B, C, D. If you just shot darts at Series C rounds, you might lose money 15% of the time. Whereas in early stage venture, you're going to lose money at least half the time. So your hit rate's going to be much better. And of course, if you can judge these companies well and invest in the best 5 out of 150 or 250 C rounds, you're going to outperform. This is what we like about mid-stage. Predictable duration, predictable risk, with maybe a 5% loss rate, and the rest of the portfolio producing at least a double of your money. And then sometimes, in our case, with Coupang, the Amazon of South Korea, we 20x'd our money, right? We put in 16 million and it became worth 320 million.
Wow. And were they a mid-stage when you got involved with that?
Yeah, they were mid-stage. They were Series D, led by Sequoia. Here's our model. There's 2,000 small specialist VCs in the world. No, in the United States today, in North America today. Let's call them the black belts. In this case, the black belt was Ben Sun, now of Primary Ventures. He's now on the Midas list, which is a list of the top 100 VCs by performance in the world.
Okay.
Largely due to his performance in many companies, but especially Coupang. He's a phenomenally good guy. He talks to every founder. He's extremely helpful. He's an ecosystem builder. No ego. Very, very smart. University of Michigan. Okay. So Ben was one of these small specialists who owned 6% of Coupang at the time when Sequoia, a name brand, world-class VC, was going to invest $100 million. And he didn't have any money left. That's where Alpha comes in. This is our trick pony, if you will. We partner with the small specialist VCs, let's call them the black belt, to be their capital source for their winners, and we share the upside with them.
Nice.
And so that's why we had the good fortune of getting into companies like Coupang and 8 others that have gone public. And in those 8 companies, we more than tripled our money.
Nice. So you get a lot of wealthy families to invest with Alpha Partners. Some notable ones like the Pritzkers and other super wealthy families. Is that how you built your fund? Is to bring in other investors and then create a pool?
Yeah. So that general partners puts in our capital. That's me and Steve and the team.
Right.
And then we go out and raise capital from mostly family offices, but also from high net worth individuals and RIAs and multifamily offices and a handful of institutions. That's how we raised our $260 million we have under management today. And it's hand-to-hand sales, basically,
Yeah.
And then, the interesting thing, you call your investors limited partners, right? Because you're the general partners can invest our own money plus their money, and we're going to bring back the profits.
Mm-hmm.
We don't think there's anything limited about our partners. We will take their calls. We are very transparent and share all the data on all our companies quarterly. Steve and I are always available. This is the way to run the business. It's like a community. It's like a village. So whether it's, the Pritzker family on down to our smallest investor who's making his first investment in a venture fund, we consider them like family.
Nice. And you're all working together for the same result, and that's really a great thing.
Yeah.
Well, so who's the right kind of person or organization that should be investing in venture?
Well, everyone should. It's just hard for people who are not accredited or qualified purchasers and have enough wealth to get into venture. It's just hard.
Right.
And
you have to certainly be accredited, right?
10% of their retirement fund and invest it in technology. Now, maybe if it's a small retirement fund, they should just do it in public names like Google and Microsoft. But everyone should be at least 10% in tech, if not more.
Yeah.
If you're a small investor, I think you could just do a local search and find all the venture capital funds near you that you can meet. And if you're willing to write a check to the smaller funds, you got to do your diligence. You got to look at their track record. You got to look at, did they help build companies? What do they know? Are they a domain expert? But most of all, you need to look at their track record. And you're kind of getting married when you become a limited partner. You're giving them your money for anywhere from 6 to 12 years. Right. Expecting them to triple your money, which is what Alpha does. Right. So, but I encourage people, if they have enough capital, to choose a black belt VC and get to know them, because not only will they get dividends from the cash they put with this early stage VC, but they're going to now have an expert on their team because they're going to treat their limited partners like family. So let's just say you're in the restaurant business and you want to invest with a VC that does food tech, right? Because you know it.
Right.
Now you've got an expert that's combing the world or the country for the best food-related deals. And they can be a true partner to you. So anyway, this is why I think everyone should participate in the asset class.
It's a great asset class, and the returns could be significantly better. I mean, the risk is higher as well, but the returns could be significantly better than what you get in the public market.
Yeah, I mean, everyone should look at it in a range from stage. In other words, you get public companies those are liquid right now. So if you buy Google, you could sell it tomorrow. Then you have mid to late stage venture, growth equity. This would be companies that are either profitable or they're close to profits. They're typically on their way or past 100 million in revenue. This is where Alpha invests.
Right.
And the reason this mid-stage sector has become so attractive is because companies predictably keep growing at greater than 50% per year, and you can exit in a predictable 3 to 5 years, and the company's not going out of business.
Yeah.
That's where I recommend people get access. Then on early stage, you need to be prepared for your VC firm's going to lose money on half its deals.
Yes.
And the ones that are winners are going to take 10 years to fully harvest.
Right.
And if you don't get the right deals in a portfolio of 20 or 30 companies, you're not going to get the 3x return that you want to get. In fact, 3/4 of the early stage funds don't achieve that. Right. So how do you know you pick the right one? So it just has to do with risk tolerance, right? And I think for the non-family offices, people have less than 100 million of wealth, investing in public names and in mid-stage like Alpha does is probably the place to start. And as evidence of that, we have 300 limited partners, Brian. I'd say half of them, Alpha was their first venture investment.
Nice.
Yep.
Well, good. So you mentioned early stage. That would be closer to like angel investing, wouldn't it? That would be before venture, right?
Yeah.
Okay. And I was one of the original Hyde Park Angels of the University of Chicago, and then saw that 50% bankrupt rate.
Yeah.
Because that's real. That's totally real. So by going mid stage, you can minimize all those bankruptcies, and you have a much higher level of success probability.
Yeah, you should be able to minimize them to less than 10% of your capital invested.
Okay, good. Now you do have to pay more too, though, right? So we're willing to pay a little bit more.
Yeah, absolutely. I'd rather
Yeah.
pay more and know I'm in one of the 5 out of 100 top mid-stage growths this quarter, where I'm quite sure in our scenario analysis, we're going to get at least a double and could get up to 5x return with a less than 10% chance of loss. I'd much rather do that. I'd do that all day long. Maybe it's because my partner, we reached 50 and we got more conservative.
Interesting. That could be it. Now, you do a lot of speaking, Brian, and I know you're very involved in the TED world, TEDx. So tell us about that. Do you talk venture to some of that crowd?
I started the TED conference on the East Coast, TEDx Asbury, in Asbury Park, New Jersey, because I had been to the TED conference 3 times when I was in Silicon Valley, and I just loved it. It was a great experience, right? But it's, a week of your time. It's $20,000 by the time you're done. It's a little bit elitist. I love the TEDx's around the globe because they are almost exactly like the big TED conference, but they might cost $50 to attend.
Okay.
And besides getting some national speakers, which we always do, and national performers like Kaki King or Todd Reynolds, etc., you discover a lot of local voices.
Yes.
And so it's been a platform where I've been able to give founders and VCs a showcase for what they're working on, as well as local professors who have a tremendous book they're coming out with. And it's just been really fun to know the brightest and the best and to discover new voices in the Jersey Shore where I live.
Nice. And so Brian, if an investor wanted to look at venture capital, what are the minimums to get involved with Alpha Partners, and what would you have to do?
Yeah, I think one should, if you're just an individual, you should join an angel group.
Okay.
And you should force yourself not to write any checks for a year and do a virtual portfolio just like you would do in stock picking.
Okay.
Just say, okay, I joined the angel group. There's all these smart people in the angel group. I ask them questions constantly. I looked at 100 deals. These are the 5 I would have invested in. Where would I be today if I had invested? And if the answer is positive, then start investing. But in the meantime, all the other angels are going to know about local VCs. Like you were in Hyde Park, and they would have guided you to meet, Chicago Ventures or Math Ventures or one of the great Chicago venture firms. And then see if you can get in. Now, a lot of VCs will say, look, my minimum's 250 or it's 500. But you know what? If you represent a strategic value, like you run restaurant chains or you own a lot of multifamily, or whatever, if you bring value, they'll lower their minimum to get you in.
Yes. So you can bring your skills and your knowledge to help the group.
Well, that's what makes it fun.
Yeah.
Right?
That's right.
Otherwise, it's just passive, right? You might as well just give the money to your stockbroker.
Yeah, that's right. That's right.
This is why everybody do it as well. Not only will you get better returns if you put 10 to 40% of your capital to work this way, but you'll exercise your brain, your skill set, your lifelong hard-won skills, your knowledge, your relationship set. And there's no greater pleasure, I think, than helping some of these companies get to profitability and realize this.
Yes.
In the end, that's why I do it. Like I created a series of companies, Silicon Valley and New York, after a short career as a management consultant. And I was lucky enough that my partner, I'd made him money back in 2000 when I first moved from Silicon Valley back to New York. He asked me to be his partner in 2012. And I jumped on it, right? Because now, instead of me having to create something myself, I could go help 30 entrepreneurs get to the next stage.
Nice.
And I think that, go ahead.
I think you pointed out that, you can easily passively buy stocks or call your stockbroker or whatever, but this is much more of a thoughtful investment. You want to work with people that you know. It's very much about the people. and about the relationship you have with the companies, keeping in touch, doing research. It's really much more of a hands-on investment, if you will.
Definitely. In fact, it goes back to sea commerce. So in the Netherlands and in the UK, as those great sea captains were commissioning ships and going to India or to the New World to bring back goods, they would literally raise money to fund their crew and their ship. And you'd buy in as a limited partner into their ship, and you'd make a profit on what they brought back, i.e. what they carried, which is why it's called the carried interest. It goes all the way back to individuals, mom and pops, backing sea captains.
Yeah. Wow. The carried interest. Love it. So, well, that's great, Brian. Well, we've learned a lot here today, and we appreciate your joining us. And let's see how the venture world works. It's great pricing now, probably great opportunity now. A lot of our investors should consider venture as a category to invest in.
Yes.
And Brian, we are launching a diversified alts fund at 4-Star that will be a feeder fund for investors to even put smaller amounts in, maybe 50 or 100,000. And they'll be more diversified. So that's something folks can look forward to as well. But thank you, Brian, for sharing your insights with us, and thanks for being with us today.
So Brian and listeners, if we can work with your feeder fund, great. If we can help any of your listeners find early stage VCs, because we know 1,000 of them, happy to. It's a great way to make a new friend, is to help somebody get a leg up in this space.
Yes.
So I'm happy to work with you. It's been a pleasure talking to you today.
Pleasure to talk with you, Brian, and thanks again for being with us today. And thanks to all of our listeners again for being with us on today's Market Explained. We'll leave it there, and everybody have a great day.